Yet again, I'm here, your host in today's video presentation. Luando Franklin is my name. I'm the lead tutor, Chief Executive Officer, and the pioneer of SEO Accountants Tuition Center. In today's video, we are going to look at IS 32 financial instruments with emphasis on compound or hybrid financial instruments in the books of the issuer. So I'm going to explain how you separate the compound financial instruments into the debt component and equity component. Now, I want you to understand that where we have issue costs of the compound financial instruments, the issue cost must be apportioned to the debt component and equity component using their values after separation. Now, I want to explain the most important things to understand here is that, number one, the compound financial instrument must be separated into debt component and equity component. First, we need to determine the debt component. The debt component is the sum of present value of interest and the principal. These are discounted using the effective interest. So we can look at the question now, that is part 1. The directors of Aaron would like advice with regards some financial instruments, transactions that took place during the year ended 31st May 2007. For today, we are putting emphasis on numero number 1. Aaron issued 1 million convertible bonds on 1 June 2006. The bond had a term of 3 years. We need to discount for 3 years, and were issued for their fair value of 100 million, which is also the par value. Interest is paid annually in arrears at a rate of 6% per annum. Bonds without the conversion option attracted an interest of 9% per annum. Now, I want you to understand that when discounting, the discounting rate is the effective interest rate, which is interest of similar loans, but without the conversion rights. So in this case, it will be 9% per annum on 1 June 2026. The company incurred issue costs. So the issue cost must be split between the debt component and the equity component. The impact of the issue cost is to increase the effective interest rate to 9.38%. Now, the impact of the issue cost is to increase the effective interest rate to 9.38%. This increase as a result of issue cost is the one that we use when measuring the debt component on amortized costs. So now we can answer this question. The first thing that we do is to determine the debt component. Under debt component, we need to first find out the coupon interest. Coupon interest here we have 6% of 100 million. So this will give us 6 million. And now we have, in the final year, we have 3 components. In the final year, we have 3 components, the interest plus the principal. So this will be 100 million plus 6 million. So which will be 106 million pounds, or rather dollars. So the debt component now will be debt will be years, cash flows, discount factor at 9%, present value for 3 years. In year 1, that is 6. Year 2, that is 6. Year 3, it's the sum, principal and interest. So there, the discount factor, we have 0.917, 0.842, 0.772. When we multiply there, this will give us 5.50. 5.05, and there 81.85. The total here will be the debt component, 92.40. This is the debt component. The balancing figure is the equity component or equity option. The equity option here is 7.06. So if the examiner wants you to demonstrate the journal entry, will be the journal entries. We have received cash from the issue of convertible loan, debit cash, which is $100 million. Credit debt or liability, that will be 92.40. Credit equity option, that will be 7.60. So that will be the journal entry. Now we need to show the allocation of issue costs, and then we measure the debt component at amortized costs. So we can go to the issue costs. This part we are done. We can go to the allocation of issue costs, issue costs allocation, we have first we have the debt component. Debt is 92.40. Equity, we have 7.60. Total 100. Allocation is proportionate to the total. So there it will be divided by 100, multiplied by 1 million. Divide by 100, multiply by 1 million. So there it will be 0.2, 0.92. There it will be 0.08. And this will be equal to 1 million. So after the allocation, we need to reduce the values. We have debt, we have equity, the values, there is 92.4, 7.60, issue costs allocated, there it will be 0.92, there it will be 0.08. Net values, the net values there we have 91.48. Net values there we have 7.52. Is that okay now? So now we can measure the debt component at amortized cost. Debt component at amortized cost. We have the debt 91.48. Effective interest now it will be 9.38. This gives us how much? 8.58. Less coupon interest. Coupon interest does not change. Coupon interest is the same. And in this case, it will be 6. So the amount to report in the statement of financial position as non-current liabilities is 94.06. That's what will be reported in the statement of financial position under non-current liabilities. Please ensure that you understand that equity option is not remeasured. So what will be taken there will be the 7.52 as equity option in the statement of financial position. Now, this topic is relevant to students who are studying strategic business reporting. Yet again, I want to encourage our viewers to ask questions relating to this question in the chat box, and the questions will be addressed depending on the availability of time. Also, I want to encourage our viewers to make comments in the comment section about the quality of this video. All comments will be taken very, very seriously in order to improve the lecture delivery. For our new subscribers, yet again, we are encouraging you to ensure that you hit the notification button so that you are able to be notified every time when new videos are available. On behalf of FCO Accountants Tuition Center, I want to thank you all for supporting us. May God bless you beyond measure. Thank you.